Hey, welcome back. So if you've ever mentioned that you invest in dividend stocks, you've probably had someone on the internet jump down your throat questioning your ability to do simple math. Today, we are going to dive deep into the data to find out what's really going on in one of investing's biggest arguments.
I mean, this is the question, right? It splits the entire investment world down the middle. Are dividends a super reliable way to build wealth, or are they just a misunderstood trap that a lot of beginners fall into? Well, the answer, it's not nearly as simple as you think. Let's get into it.
You hear this one all the time. It's probably the most common criticism out there. The idea is that paying a dividend is basically like a company raising a white flag, admitting, yep, our best days of growth are behind us. But is that what's really happening?
Okay, before we can get to the truth, we really need to understand the arguments coming from the other side. So we're going to tackle the biggest criticisms one by one, because, to be fair, there's a little bit of truth baked into every single one of them.
Here they are, the four horsemen of the anti-dividend argument. You've seen these in Reddit forums, you've heard them on podcasts, and you know what? On the surface, every single one of them sounds pretty logical. So let's break them down.
All right, let's start with the one that's all about the numbers. The most mathematical argument of them all. This idea that dividends are just, well, a financial magic trick where nothing actually happens because the stock price just drops to cancel it out.
And what's so interesting here is that, well, the math is absolutely correct. So let's say a company earns $5 a share. It decides to pay out 4 of those dollars as a dividend. The day the stock goes ex-dividend, which just means that new buyers won't get that payout, the market automatically adjusts the price down by that same $4. So the critics are right. It is not free money.
Okay, so if the math says it's basically a wash, then why do we even care? Well, because this is exactly where looking only at the math misses the entire point. The real story here isn't about the numbers on the screen. It's about who gets to decide what to do with those numbers.
And this, right here, shows you the fundamental difference. When a company keeps all its profits, you are placing your trust in the management team to make smart decisions with your slice of the pie. But when a company pays a dividend, they hand you your slice. You get to decide what to do with it. Reinvest it, spend it, maybe put it into a totally different company. The power literally shifts from the boardroom to your hand.
Now, people will immediately say, yeah, but you have to pay tax on dividends. And look, that's true. But I want you to think about it this way. That tax, that's the fee you pay for gaining control. It's the price of flexibility. It's the price you pay for the option to allocate your own profits yourself.
Okay, next up, let's tackle that second big criticism. The idea that paying a dividend is basically an admission of defeat, a signal that a company has just plain run out of good ideas for growth. And this is where things get really fascinating. If you look at the total return over the last 5 years, you'd probably expect the pure growth stocks to just blow everyone else away. And yeah, Google did great, no question. But look who's right behind it. McDonald's and Starbucks, two classic, boring dividend payers. They actually outperformed growth darlings like Berkshire Hathaway and even Amazon.
So what's the takeaway here? Well, it's that a company's plan for massive growth doesn't always translate into a higher stock price for you, the investor. Sometimes, a super stable, reliable business that just consistently makes and distributes cash ends up being the better overall investment. So we've looked at the math and we've looked at the growth argument. But now we're getting to the most important part of this entire story. This is the part that isn't about spreadsheets. It's about human psychology. If we pull back the lens and look at broad index funds over a 25-year period, the debate seems settled. Vanguard's growth fund delivered an 11.37% average annual return. It clearly beats the two dividend-focused funds. So case closed, right? Growth wins. Not so fast. Because that impressive 11.37% number only matters if you can actually survive the journey to get there. And for most people, that journey, it's an absolute stomach-churning roller coaster. Let's make this real. Just imagine you bought Metastock 5 years ago. Yeah, you'd be up 80% today, which is great. But look at what you had to live through to get there. A year and a half in, your stock has plummeted. Then it soars to a new high, you feel like a genius, only to crash all over again a year later, putting you down 46%, 4 years into your investment. Seriously, how many people do you think actually held on through all of that? The data says not many. A recent study found that 2/3 of all investors admit to making an impulsive, emotionally driven decision with their money that they later regretted.
The insane volatility of that growth journey makes it incredibly hard to just stay the course.
And this really gets us to the heart of the whole thing. The best investment strategy on paper is absolutely worthless if you can't emotionally stick with it in the real world. We have to build strategies for humans, not for robots.
This is the dividend stock's secret weapon. It acts as a psychological anchor. When the whole market is going crazy and your portfolio is flashing red, that quarterly dividend payment still shows up in your account. It's real. It's tangible proof that your investment is still working for you. It keeps you sane and stops you from panic selling at the worst possible time. This brings us to a whole different way of thinking about investing. Maybe the goal isn't just about chasing the highest possible return, no matter what. Maybe the real goal is to find the most reliable path to your destination, a path that you can actually stick with, come what may.
And the good news is, you don't have to choose one or the other. For most people, a blended approach is probably the most practical. You can use a growth fund in your retirement account where you're not tempted to check it every day, and you can complement that with a portfolio of solid dividend stocks that gives you that steady, tangible progress to keep your mind focused on the long-term goal.
So, we'll leave you with this thought. The whole debate between growth and dividends gets lost in spreadsheets and formulas all the time. But what if the winning strategy has less to do with maximizing every last percentage point and more to do with understanding and managing the one variable that truly matters, yourself?